Okay, well, good afternoon, everyone. I am Stephanie Arroyo, the Business Development Manager for Greater Nevada Credit Union. And thank you for joining us on this recorded presentation. We'll be putting everyone on mute until the Q&A sections. Just a quick intro to our team. Chris Holland will be voicing your questions, and we also have Saray Helms and Michelle Hale handling our chat conversations. So please feel free, you can put your questions in the chat, or you can wait until our Q&A sections and voice those yourselves, whatever is more comfortable to you. Greater Nevada Credit Union is the official credit union for Renown Health and Greater Perks Partner. With this partnership, we're providing financial wellness to all of the employees. If you're interested in learning more about the benefits of our Greater Perks program, please reach out to your Human Resources Department. Renown has reached out to us to provide information that has impacted their employees. Today's presentation is on purchasing a second home, and I would like to introduce you all to our presenter, Mike Randall. Mike joined Greater Nevada Mortgage in 2015, bringing with him 16 years of experience in the mortgage industry. Mike is the sales manager for Carson City, Minden, Gardnerville, Dayton, and Eastern Nevada, and his experience ranges from loan origination on both the wholesale and retail sides of the industry to management of retail offices throughout Nevada and California. He strives to build strong origination teams through communication and support that the loan originators can be successful. His goal is to build strong relationships built on trust with his team. He is active in the local real estate community and continues to volunteer his time within the community of Carson City. He's a native Nevadan, and Mike has spent the majority of his life in Northern Nevada, where he enjoys camping, hunting, golfing, and mountain biking with his family and friends. Welcome, Mike. Thank you.
Thank you, Steph. That was quite an introduction. Yeah, it's I can't, when you say that, 2015, 16 years, I guess that puts me over 20 years in this industry. It goes by fast, and as time does. But yeah, welcome everybody. Thanks for joining us here today. Today we're going to be talking about buying second homes, vacation homes. And so just kind of hopefully answer any questions you might have with that, any reservations that you might have when it comes to, to buying real estate and real estate, especially as a vacation home or somewhere to spend part of your time at. So with that, I'll go ahead and get started. Let's see here. There we go. So there are, a lot of reasons to buy a second home. And so I want to go ahead and preface this by saying this presentation is about buying a second home or a vacation home. This is not a presentation on buying investment properties. Investment properties, like if you were saying, hey, I want to buy a second home, and let's, for instance, let's say in Tahoe, and then when I'm not staying there with my family, I'm going to go ahead and rent it out, or I'm going to turn it into an Airbnb, or I'm going to do VRBO. Okay, that's a investment property, right? You're buying that as an investment property. You're buying that to make money with it, and then when it's not making money, you're going to use it. Okay, so let's go ahead and separate that. Those are two different things. We're talking about buying a home that you will use as a second home, for any multitude of reasons, but it really is about a second home, somewhere to stay, and we can get into some of those reasons, and if you have any scenarios or something like that you want to talk about, I can definitely try and address that for you. Let's see here. Reasons. There you go. There we go. First one, obviously, vacation home, right? And keep in mind, vacation home doesn't technically have to be like in a vacation location. Obviously, people think of places like Lake Tahoe as a vacation home, or Palm Springs as a vacation home, something along those lines. It doesn't necessarily have to be in a super vacation area, a Del Webb type community or something like that. There's a lot of different ways you can explain a vacation home. I recently had one that the people both worked for the state here in Carson City, husband and wife, you know, they worked for the state of Nevada here in Carson. They had their primary home here in Carson, but they wanted to buy a vacation home in Elko because I think their kids were out there. Their kids were having children, so they had grandkids, young grandkids, and then they also, you know, they were big avid hunter fisherman people, and so they were truly buying a second home for somewhere. So when they went out to see the kids and stuff like that, they could have a place to stay, and it wasn't, you know, again, they're not renting it out. They're not turning it into a rental property. It's truly was their second home. That qualifies. That qualifies. And so it truly is a vacation home. And you know, it's not like a set distance for something like that, because for many of us, right, we live right here in Carson City, and Lake Tahoe being a vacation area is, you know, it's whatever, 15 minutes up the hill. So it's not like it has to be a certain amount. It just kind of has to make sense to an underwriter. Now, if you were to say, hey, you know, I live in Carson City, but I was thinking about buying a vacation home right here in Carson City, or a vacation home right here in Reno, which is 25 minutes away. Yeah, they're probably not going to buy off on that one. They're probably going to, you know, they as in underwriting, they're going to, you know, want to call that an investment property, because people don't typically have vacation homes or second homes in the same town they live in. So, you know, that would be one of the reasons you want to buy a second home. Commuter homes. This is absolutely, you know, something that we come across, especially if, you know, like say you live in a big city, but your main primary residence where you live is a distance away, but you work, you know, let's say you lived, your family, your home was in Walnut Creek, right? Your kids are in Walnut Creek, all your life, your wife, everything like that, your primary home is in Walnut Creek, but you worked downtown San Francisco. You're right, you might have a commuter home in that sense. So all during the week, this way you're not commuting back and forth across the bay and all that kind of stuff. You lived in that commuter home, and then on the weekends you went home. That would be something that, you know, you could get an underwriter to buy off on. I don't know, like I said in my earlier example, I don't think you could get away with saying, hey, I live in Carson City, or I live in Reno, but I work, you know, in the other place, and so I want one there. They're probably just going to, you know, call it an investment property, you know, which has, you know, just some different, and we'll get into that a little bit later, has some different requirements around it. Okay. Just want to invest in real estate. Like, look, we all know, right? This presentation is people buying second homes. Probably likely already have your primary residence, or already have other real estate that you own, right? If you've been involved in real estate especially in the last 10 years, you've probably done very well with equity and stuff like that. And you know, most vacation areas are good investments, because they tend to just go up in value, right? I don't know anybody that's been in this community. You know, imagine if you could have bought into, you know, the Lake Tahoe Basin in 2010, where you'd be at today with that home, right? And it's you know, it's a very expensive place to live or to have a second home, but you know, investing in real estate, it still is an investment, and probably a good investment. Looking to upgrade. So this is you know, an interesting idea around buying a second home. You know, a lot of times people living in a certain home, and then at their primary residence, and they're like, hey, I want to buy another home, and then we're going to turn the one that we currently live in, we want to turn it into a rental. That happens a lot, okay? And it doesn't even have to be a second home at that point. You really can upgrade your home. It could just be a regular purchase, and then the home you're vacating, you're going to hold on to it, and you're going to turn it into a rental. That's actually not even a second home. That's a primary residence, and it happens a lot where people, you know, move out of their main house, turn it in, or their primary home that they've been living in for at least a year. That's the rule. You have to be living, if you called it a primary, you have to live in it for a year. And then, you know, they move up, they upgrade their home, and then they turn that one into a rental home. Happens all the time. That's actually not a second home. Okay. That's a primary residence. And we do those too. And buying a home for a family member. So this comes up from time to time, especially if you've got, maybe kids in college, like I've got a couple of them up in Reno too, where paying, instead of paying all that money in rent, you buy a second home, maybe in Reno for for your kids to move into and live. Could you do that? Yeah, you could do that. As long as you're not renting out all rooms and making money on it and claiming it on your taxes as an investment property, then that's a second home. Same thing when you've got maybe aging parents, right? That you're having to maybe buy a second home for them to live in, something along those lines. Yes, 100%. You can do that as well. Again, it's about how you're handling it, how you're, handling, especially with your with your taxes and how you report it to the IRS every year. Okay. Again, second homes are not meant to generate revenue, but that's an investment property. And we do investment properties. You can do it, right? But there's just some, and I'll get into that a little bit later in the presentation. But that's not truly a second home if you're using it to make money. Okay, so some of the things that come up a lot and things you just kind of have to be aware of, right? The costs of buying a second home. Obviously, the costs of the mortgage are they are what they are. You're going to have to pay your lender, right? We make money. We have to keep the lights on. We have employees and stuff, right? We have to make money. You're going to have a title company, right? They're the one that makes sure that the type that, when whoever you're buying the home from, right, they come off title so that you have a clear title. So it truly is your property, legally your property. Make sure there's no, weird things with the title and that it's nice and clean so that nobody can come back and say, oh, hey, actually I own that home, right? They go through and they insure that title to make sure that, there is none of that. So the title company, and then of course, paying all your for those of you already own a home, you're going to be paying your impound account, which is like your taxes, monthly property taxes, your homeowner's insurance and stuff like that. You have to set all that up right when you close. So if you're going to have all the closing costs of a loan, but then, you're going to have the other parts of it too. And the top line there is your insurance, right? It's a homeowner's insurance. On a second home, it's probably going to cost a little bit more. It's never, homeowners insurance is typically pretty affordable. But I will say there's something to keep in mind too. And as you start going down the road of looking at second homes, we're actually having quite a bit of, I should say trouble. I don't know. There's in mortgage right now, especially on the homeowners insurance side, a lot of the homeowner insurance companies are pulling out of areas that are potential to burn. Okay. And we're living through this right now, right? We've just lived through the Lake Tahoe fire, right? And then the Dixie fire. California's been on fire for the last couple of 3 years in the summertime. And these towns and these municipalities are getting completely wiped to the ground. And of course, those insurance companies have to go back and rebuild those homes, right? And everything else that was lost inside of it. And so insurance companies, they are not required to insure you, right? It's not, you can't make an insurance company put coverage on you. And so insurance companies have actually been going through some of these areas that are heavily wooded and potential to burn, and they're just canceling policies. They're just saying, hey, look, we're not going to insure you. Obviously, they can't do that during a burn event, but they can do it when it's not during a burn event. I would not be surprised at all to see a lot of the homes in South Lake Tahoe, which was just under, that fire warning, and everybody got evacuated last week. I would not be surprised at all to hear about insurance companies just pulling out, saying, hey, the fire's out, but we've decided we're no longer going to insure. So it's just something to keep in mind, as you start looking for some of these vacation home properties. You may want to talk to your insurance agent and just say, hey, do you guys have a problem insuring in this area? And because it is, insurance companies are getting pretty tough to work with in some of these areas that are potential to burn because of trees and all the stuff that we love to look at. So keep
Mike,
that in mind.
let me break in there. While we're talking about costs of buying a second home, we had a couple of questions come in on the chat and one on the email. The one from the email was asking about interest rates, and the question is, are interest rates higher on a second home?
Yeah, and I will get to that. You bet. They are.
Perfect. Let me give you a couple more here that are coming in on the chat. And you sort of brushed on this one a little bit earlier, but what's the minimum distance from your primary home to your second or vacation home?
Yeah, not again. I kind of touched on this earlier. It's a good question. There isn't really like a minimum distance per se. It just has to make sure, or I'm sorry, it has to make sense to the underwriter. Okay. And as I say, there are a lot of people that live in Carson City that own a home in Lake Tahoe, right? And that's only 15 miles up the hill, right? It's not that far away. It's still a second home. It just has to pass kind of the test of that. You know, same thing. If you lived in Carson and or even in Reno, and maybe you bought a second home at the university, right? Because you're like, hey, I'm buying this second home, you know, for my kids are going to live there or whatever it is while they're going to school. You know, again, that's all underwriter discretion on that kind of stuff. So there isn't like it just has to make sense. What they're trying to sift through on that is underwriters, when I say, you know, that pronouns, they use a lot of pronouns, sifting through the they on that. They just want to make sure that, because there is a difference between a second home and an investment property. And the differences I'll get to a little bit later, but they are interest rates different, okay? And the amount of money you have to put down different. And so they want to make sure that you're not really saying, hey, I just want the second home so you don't have to put as much money down and you get the nice low interest rate, versus I'm actually going to turn this into an investment property. Okay.
Gotcha.
And so I'm just going to make money with it. And I'm going to stick, you know, I'm going to do Airbnb and we're going to make a bunch of money. And right, that's an investment. Right. And so they're trying to sniff that part out to make sure. And sometimes if it doesn't pass the smell test, it just means you got to go with the investment direction. Right. And that's okay too. It just means you got to put a little bit more money down. The interest rate may not be as aggressive as you were hoping for, but yeah, it's a good question. Go ahead, Chris.
And let me give you one more, and then you can get back into your presentation. This question also on the chat: how long do I have to wait to buy my second home? It looks like this person just purchased their home in 2020.
Yeah. Excellent. I'm glad it came up. So when you sit down to sign your loan documents, the easy answer is 1 year. Okay. You sit down, you sign your deed of trust, right? And your mortgage note and your deed of trust. For those of you guys that have bought homes, and and you sit there and you sign and you sign and you sign at the title company, right? That if the fine print, and I know everybody just signs it, nobody really reads it because you'd be there all day. The fine print on there says you will take occupancy of that home. If it's your primary residence, you will take occupancy within 60 days, right? Which means it's going to be your primary home within 60 days. That gives other people a chance to move out, and you get a chance to actually, you know, get your stuff in order and move in, and you will occupy it for 12 months. Okay. That is the note. So, the question is, how do they verify that, right? There's a lot of different ways. And I say they, in this case, would be Fannie Mae for us, right? We work exclusively with Fannie Mae for this type of property. Fannie Mae actually spot checks it. Okay. They send out independent third parties, and they will just, if somebody has bought a home as a second home, or somebody has bought a home as a primary, and there's some, I'm sure they've got their triggers in their system. It's like, is this really a primary? They will go and send people over, and knock on the door and just say, hi, we're looking for, whoever purchased the property. And if the people that answer the door can't produce the fact that they are the people that signed the primary loan documents in that first 12 months, they will accelerate the mortgage and ask to be paid off, which they have the right to do. And so, people want to buy investment properties, but they don't want to put all the money down that investment properties require. and they don't want, you know, and they want the nice, really low interest rates that you get when it's a primary versus an investment property. And so, yeah, 1 year to answer that question.
Thank you, Mike.
All right, Chris. All right. Some other things that on that list, utilities, right? Just being aware that when you're buying a home, right, not only is the homeowner's insurance going to cost a little bit more, you're adding on not just your principal, interest, taxes, and insurance, right? Payment, we call it the PITI of your loan into your, you know, into your monthly expenses, but you got things you got to think about, right? Which are, you know, your utilities, which is your electricity bill, right? It's gonna be added on to your monthly expenses, your gas, your water, your sewer, your garbage, all of that stuff. So if you're like, hey, I'm gonna buy this house and it's gonna cost us an extra $2,000 a month, right? Well, it's not just that, right? It's electricity, gas, water, sewer. And on top of that, there's also homeowners associations. I put that on the bottom. But these are all just added things to just kind of keep in mind. And obviously you're buying a second home, you're probably already, you know, kind of have that in your mind. But it's not just the, hey, I'm gonna sit down with my loan officer. My loan officer says the payment's $2,000. It's not just $2,000, right? It's $2,000 plus, 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 plus. Just kind of keeping that in mind as you go through that. Maintenance on second homes, right? Now you have 2 refrigerators, one at your primary, one at your vacation home, right? HVAC, that's that's your heating and air conditioning units, right? You got 2 of them now, right? One on your home, one on the vacation home. Hot water heaters, painting, exterior, right? Painting, that's the kind of stuff, especially in some of these vacation areas, right? They tend to need a little bit more maintenance on that stuff. And any seasonal stuff like snow removal, whatever it is, and we deal with a lot of that around here. So it's just all out-of-pocket expenses. You just kind of have to keep that in mind when you're thinking about buying a second home. And then that last bullet point on there are homeowners associations, right? A lot of times homes that are vacation homes sit in these little communities, right? That are built out and they have all the nice amenities that go with them. Some of them have, maybe have a swim pool and stuff like that in them. But they're in common areas that are kept nice, but with that is additional HOA monthly fee that goes along with them. Some of them can be exorbitant high. So just kind of things to keep in mind when you're thinking about buying a home. All right. The different ways of financing a second home, right? Obviously, the first one is what we've been talking about, which is your conventional Fannie Mae, Freddie Mac. They will do, second homes, vacation homes. Okay. The other types of financing, government loans, right, which are your FHA loans, your USDA loans, okay, your VA loans, those are primary homes only. Okay, we cannot use government loans for people when they're buying vacation homes. They're 100% for primary, usually just people trying to break into home ownership. And so it's when you're looking at vacation financing, Fannie Mae, Freddie Mac only. Okay, those are our 2. We call it conventional loans. Those are the only 2 that go along with that. With that, there are some restrictions, right? And you can talk to your loan officer about this, but the restrictions are there's only a certain maximum loan amount that you can get on a conventional mortgage, right? Right now it's $548,250. That is the maximum loan amount you can get. There are what are called high balance or high cost areas that go up from there. Obviously, we couldn't lend on it, but if you were buying in Hawaii, right, it's much higher just because the homes are so much more expensive over there. If you were buying down on the ocean, Huntington Beach or anywhere, Newport Beach, anywhere along there, the conventional loan limits are much, much, much higher, up in the 800s, right? Because they have to be, because those areas are so expensive. But those are, they have limits on what anything above that number, you don't get hung up on it. Your loan officer will help you out with that. Turns into what's called a jumbo loan. And now you really get restricted on what you can do because jumbo loans require more down payment, higher interest rates, more reserve requirements. There's just some things that come with jumbo loans because obviously you're borrowing a significant amount of money. Home equity line of credit. we do home equity lines here. It's an option, right? If you were like, hey, I got my primary home, I have a whole bunch of equity in that home. I just want to do an equity line of credit, take that money, go buy a vacation home. You can 100% do that. You can even do it through us. Downside of home equity lines is they're essentially they're like a credit card on your home, right? And that is, the interest rate is not fixed. It is, as Wall Street Journal Prime moves up, and we are probably going to start seeing some of that, where interest rates are going to start moving up to hold off inflation and stuff. The equity line moves up, right? So today an equity line might be at 3.25. You're like, wow, that's awesome. It's an awesome interest rate. But in 2 years we could be at 5.5, right? And it just moves up anytime the Fed wants to increase that, they increase it, and they will. And so you kind of have to be careful with home equity lines. The other part is they're interest only for the first 10 years, which means when you make your payment every month, it's only the interest. There's no principal pay down on it. And then after 10 years, they lock up and you can't use them anymore. And then it goes into a repayment period where you have to pay it off in 15 years. And so then those payments really come pouring in. And so it's just, an equity line is absolutely, a resource for buying that, but you just kind of have to be careful with them because, obviously it's a lot of money and it's not a fixed rate. It can move up, however many times a year. There's no cap on it. And then of course, the easiest way is cash, right? If you happen to be lucky enough to be able to buy a second home with the money in your bank, then you probably don't need to be on this call because you just go out and buy one. All right. Requirements. I would say 700 is a good rule of thumb. Okay. Your credit score drives everything anymore. And most people have a pretty good idea of where their credit score is at. There's a lot of tools. You can get a free credit report, once a year, but most people know their credit cards. There's usually a little whatever on the credit card apps you can click on there. It'll tell you what your FICO score is, right? And just kind of they keep track of that. Credit cards are especially good at monitoring your credit report because they want to know if you stop making your payments over at Chase, right? Citibank wants to know because they want to be able to shrink down your line of credit if it looks like you're in financial trouble because they don't want to be the last one holding the bag, right? And so they all keep a real close eye on what's going on with each other and what's going on with your credit score. I would say a 700 is probably a good rule of thumb. Just to kind of be in that area. You get below 700 and it gets a little bit harder to get approval. Everything we do anymore is done through what are called automated underwriting, AUS, automated underwriting systems. Through Fannie Mae, just, we put all the information in. It looks at things like how long you've been at your job, how long have you lived in your primary residence, right? What is your debt to income, which is how much debt you have compared to your income, right? How much money do you have in reserves? All this stuff that makes up your picture. But the biggest part is your credit score. We put it into the system and it will tell us, the system will say, hey, Fannie Mae, we'll buy this loan. Could you get lower than a 700? Yeah, probably. But like I said, it gets tougher and tougher with, with once you get below 700. So I would say, 700 is probably a good rule of thumb when you're looking at that. And again, if you don't know your credit score, it's totally fine. You can work with one of our loan officers. They'll pull your credit and kind of get you moving down the road, answering those questions you have. Debt to income. Okay, this is another one that seems, like lending jargon, right? But it's essentially, it takes into all your debt, right? Your mortgage payment, all your credit cards, your car loans, your student loans, all those payments, right? it takes into account exactly what your payments are compared to how much income you have, right? Coming in every month. Everybody has a certain amount of income coming in, and we want to make sure that your 45 would be getting pretty high, but depending, again, good credit score, how much money you're putting down, if you have reserves, stuff like that, all that stuff goes into the equation. I would say you probably wouldn't be able to get much above 45. But probably a good rule of thumb when you're looking at that. Obviously, the lower your debt to income, right, the better qualified you're going to be as far in doing this, and the less requirements it'll have for the amount of down payment and for just overall reserves. Mortgage rates. Mortgage rates are a big one. Okay, you can't. Credit card lates or car loan lates and stuff like that, all that stuff reports into your credit score. If you've got a couple of those in the last 12 months, your credit score is probably not going to be a 700, right? It's probably going to be below that, but there no mortgage lates in the last 12 months. You absolutely cannot have it. If you've got lates on your primary or any of your other real estate investments or anything like that, you're probably not going to be able to get an automated approval on that. Okay. Strong income history. So what do they mean by strong income history? Just how consistent is it, right? If you don't have consistency in your income, if you don't have consistency in your income and you're moving from job to job to job, you've had a lot of job changes, in the last couple of years. Now, obviously, if your job changes are moving up the ladder, that's one thing. But if you're like switching a lot of jobs and stuff like that, it just makes it a little bit tougher, especially when you're buying a second property, right? Not a primary, but a second property. It just, adds kind of stress on that. And then when you're buying a second property like this, a vacation property, there's that word, that acronym again, PITI, right? They're going to be looking for probably 6 months PITI, right? Principal, interest, taxes, insurance in reserves, okay? On all your mortgage payments, okay? It's not exactly that, but that would probably be a safe place to be. So what that means is if your current mortgage payment is $2,000, right? On your primary, right? And then you're going to be also buying a new home, and let's say that one's $2,000, right? You're going to be looking for, what is that, that's 12 grand, that's 24 grand, right? They're going to be looking for you to have now, it doesn't have to be liquid reserves. It could be your 401k at work, right? Or if mutual funds or whatever it is. It doesn't have to be like, hey, I've got 25 grand sitting in that account right over there at Greater Nevada, right? In my checking or my savings account. It doesn't have to be that. It can just be, have to be able to access it. You have to be able to get at it. And the reason they want reserves, right? We want strong job history. Obviously, it's a big part of qualifying people. But, what happens if you lose your job? What happens if you, whatever, get in an accident, you can't go to work, lose your job? I don't know, whatever happens there, life happens, right? And they just want to make sure that you can make your payments for a while you're on your mortgages, right? Those are really important. We want to make sure you can handle your mortgages if you were to lose your job or something, life happens and your money had to go someplace else. And so that's why they ask for reserves. All right, for us to stop and ask if any questions have come up. Chris.
Question break. Yeah. Take a drink, catch your breath. We've got a couple here. Let me give you the first one. And thanks everybody for putting these in the chat. And I also have one from email I'm going to give you. The first one is, can I purchase a second home with a group of people to make financing easier? And they're giving us the example of, can I purchasing with my in-laws?
Yeah, I suppose you probably could. Yeah. We don't do, I know this is, what do they call that? Fractional ownerships, right? That's a little different situation. Buying a home with your in-laws, a second home. Yeah, I guess I could see how that, yeah, I don't see a problem with that. It would be, everybody's credit would have to qualify, everybody's income would have to flow through. that debt to incomes and stuff like that. But yeah, I suppose you could definitely have them all on the same application to purchase a home. Yeah.
Got it. Yeah, thank you for that. Here's one that came in email. It says, if you had a bankruptcy, does that disqualify automatically? And they said, though it may have been several years ago.
Yeah. Excellent. This is a great question. Okay. And I'm honestly, this kind of stuff I hear all the time. Oh, I had a bankruptcy, I got to wait 10 years. Absolutely not. There are waiting periods, okay, for bankruptcies, and they are 4 years, okay? Just the easiest way to, there's several different types of bankruptcies, right? There's Chapter 7, there's Chapter 13, there's Chapter 11s, and all these different types of bankruptcies. Best rule of thumb is 4 years. If you've had a bankruptcy and you're trying to buy, a vacation home, you need to wait 4 years, right? And 4 years, and that's 4 years from the discharge date, not from the day you actually, that you filed your bankruptcy, because you go through your filing and then the court either releases you or discharges all the debts, but it's from that day when they discharge the debts, okay? Foreclosures, okay, we don't have very much from short sales. Short sales are more from 2008 and 9, maybe not 10, but 8, certainly 2008 and 9. We're well beyond the waiting periods on short sales. Foreclosures are 7 years, okay? So if you've actually had a home foreclosed on, your wait is 7 years. And again, that's 7 years from the day they foreclosed on you. And so that's an excellent question. There's a lot of, just bad information out there, and it's okay, right? And that's why you just need to talk to a mortgage, mortgage person, your loan officer. We call them mortgage consultants, but they're loan officers. That's their job. Their job is to know these waiting periods. And so, I've heard people say, "Oh, I got to wait 10 years I had a bankruptcy. I can't buy a house." Absolutely not. Especially when it comes to a primary. Heck, we can go 2 years if you spent a primary and you had a bankruptcy. So, but as far as a second home, vacation home, it's 4 years. Good
Okay,
question.
thank you. I've got two more coming from the chat, and maybe this one sort of relates to the one that you just answered a couple moments ago. The question is, whose score do you use when buying with your family?
Yeah, so that's a good question too. So they're going to look at everybody's scores, whoever it is, right? You get all of the borrowers, okay? There's 3 bureaus, right? So you got 3 bureaus, and they're all going to have a TransUnion, Equifax, Experian. They're all going to have a different score. I've never seen them, for whatever reason, they score it different. They're all usually pretty close, within a couple points of each other, but they all have different scores. They use the middle score from everybody, and then they choose the lowest of those middle scores, okay?
Interesting. And the last one, and then we'll let you get back into your flow there, is Can I buy a second home in a different state?
100%. Again, if you're buying it to, as a vacation, you're not buying it to rent it, or not trying to turn it into an Airbnb or a VRBO or something like that. If you are truly buying in a different state for whatever reason, and you are saying, hey, this is a second home, and they may ask some questions, to prove that it's your second home, yes, you can buy in a separate state, by all means.
Great, thanks. Yeah, roll on, my friend.
Okay. A couple scenarios here as we kind of close in. How much time I got left? About 20 minutes. Okay. This is the first scenario I want to run through. Katie wants to buy a second home in Incline Village that she can share with her family to hang out at the lake in the summer and then ski in the winter. Okay. And so I kind of ran through this scenario with vacation homes. Okay. You have to put a minimum of 10% down. Okay. It's not like your primary home, right? We have programs where you can put 0 down on a primary home, but on a second home, you have to put a minimum of 10% down. Okay, so let's say you're buying up an Incline Village. So I just put maximum sales price up there. It'd be like 605. Obviously you're not buying on the lake at that, right? But you're maybe back up in the trees. You found something for 605. Your down payment in this situation, you're putting 10% down, which would be $60,000. There's going to be closing costs as well, right? So you're going to have additional closing costs, but just your down payment alone would be $60,500. Okay. And then that puts your loan amount at 544, 500. I hope I did my math right there. So that would be your loan amount. And in that case, you're actually below that maximum loan limit for Fannie Mae of 548, 250, right? You're below it, so it would fit into Fannie Mae, but it's going to require mortgage insurance, okay? Because so anytime you're in a mortgage and you're above 80%, you're gonna have mortgage insurance. Now, I know people are like, oh, I can't stand mortgage insurance. It's an incredible tool. It's unbelievable, right? Because we all know how hard it is to save money. We all, every month, right? You put a little money away and then you got to get new tires or whatever it is. Like, oh, dang it, there goes that savings account. And so it's really hard to save money. And mortgage insurance is super cheap compared to what you're actually doing. And so in this case, right, you're putting your $60,000, you have to come up with another $60,000 just to get down to a point where you didn't have mortgage insurance. Okay. I did the payment on this thing, and I think the mortgage insurance for that $60,000 was $140 a month. So rather than putting another $60,000 down, it costs like $140 a month in this payment. So mortgage insurance is an incredible tool. I mean, honestly, it's just changed home ownership for most people. But again, second home, vacation home here, putting 10% down. We're going to require mortgage insurance. Interest rates. This is a great spot for me to enter into interest rates. Interest rates on second homes are not as good as your primary, right? Now, that being said, about a quarter percent higher in rate. Okay. I ran this scenario last night, and I think the rate was 3.1 on a 30-year fixed. Okay. Oh, yeah, I put it right there at the end, 3.1, 3.125. So I just wanted to take this point, like on a truly a second home, you're not going to get as good of a rate as you would on a primary residence for obvious reasons. There's more risk, right? And that's if you got into a point in your life where you had lost your job and all your money was gone, and right, and you're not going to keep on making the payment up at Incline Village, right? You're probably going to make the payment on your house where your family lives, right? And it's that'll be the last stand, right? And so because of that, the house in Tahoe has a little bit more risk to it, right? There's risk involved there that you might actually, if something really bad went, you would let that one go. And so that's why interest rates are a little bit higher on second homes, just because there's more risk. It's just same thing, credit cards, right? People with really high credit scores, and they do a good job making all their payments every month. They have excellent credit scores. Their interest rates on the credit cards tend to be in the low single digits versus somebody who struggles with credit or maybe hasn't been good at their payment history or runs really high balances on all their stuffs and their credit scores are in the 600s. Their interest rates are probably in the 20s, right? And so it's the same thing with mortgages and car loans and everything else. The more risk you have, the higher the rate. So in this case, there's a little bit more risk on a second home, so the interest rate's going to be a little bit higher. So I wanted to just show you here. Here would be the payment on this, on this $544,000 loan. 30-year fixed, right? You've got P&I, principal and interest, okay? And then your MI, okay? It was about 2473, okay? That's somebody with a nice FICO score of 750 and a rate of 3.125, sorry. 3 1/8, we call that. And so that doesn't include taxes, obviously, right? Left that out. I'm sure taxes in a Incline Village are going to be high, right? I mean, that taxes on there, it might be $400 a month. Doesn't include insurance. Again, that goes back to my earlier discussion. If you're looking at homes in places that could potentially catch on fire, you may want to talk to your insurance agent first, right? Just be, hey, we're getting insurance up here, and how much are we looking at on something like that, right? And so I left that part out. That's why you only see P and I instead of PITI, okay? And so 2473 on that high a loan amount. I don't know what your taxes and insurance, I mean, it could be another $600, right? So you're up over $3,000 on that one. And so it's just, that's the kind of scenario I wanted to kind of run by. You kind of wrap your head around, what a payment would be on something like that. Okay. Scenario number 2. Josh is looking to buy a home that he can use when he wants and still convert it to a vacation rental. Okay, there's that whole vacation rental. Does he want to use it in a vacation area? You bet. Okay, but he also wants to turn it into a vacation rental. He wants to make a little money on it when he's not using it. Can we do that? Yes. Okay, it's called an investment property. Okay, investment properties, you know, again, that whole FICO score, does it have to be a 720? Maybe not, but you know, I'm going to use that as a pretty good rule of thumb. You're probably looking at, if you're investing in real estate, you're probably looking at somebody with a little higher FICO score. There's the one down below that. It's a 20% down loan. Okay, you need 20% down to do an investment property. That's still kind of high risk, and your rates are going to be high because you're only putting 20% down. Because again, Fannie Mae knows that if things get tough and you run out of money, you're not going to make your payment on your investment property. You're going to make your payment on your primary. Okay. And so investment properties are usually the first ones to stop making their payments on. So you can see there, I ran this through the system, 720 FICO score, 20% down on that same $600,000 home. And the rate was still 4.75. Okay. If you put more money down, obviously, the more money you put down, the less risk there is, and the rates go down, right? But 20% is the absolute minimum on an investment property. Okay. And then there's that 6 months reserves, right? Guaranteed you're going to need 6 months reserves. Okay. Again, it doesn't have to be liquid, like sitting in your bank. You just have to be able to get at it. But yeah, that's, in this case, if you're turning it into an investment, that's what it is. It's an investment. Okay. Full impact. Okay. I love this first bullet. Okay. The financial responsibility falls on your shoulders twice, or 3 times you own 3 properties, 4 times you own 4 properties, whatever it is, right? You have twice in monthly payments, twice the insurance, twice the taxes, twice the maintenance. Listen, I know if you're here today, right, you've already thought that through, but there's going to be twice of everything, right? Same thing with all the maintenance and everything else. You know, that there's that thing about reserves, right? Life is what happens when you're making plans, right? Just make sure you still have reserves saved for emergencies. Emergencies happen, right? And just kind of thinking that through, you know, just making sure you have those reserves. You know, buying a vacation home is investing. It truly is. It's investing in real estate, right? And over the last 10 years, it's been an incredible investment. Historically, real estate is the best investment there is over the history of the last 100 years in the United States. It's been an amazing investment. And so you truly are. And, you know, and so, you know, it's something definitely to think about. But you can also talk to one of our financial planners too, right? Greater Nevada has financial planners, you know, about retirement income and everything else. But, you know, just things to kind of think about when you think about the impact of buying an investment property, you know, just making sure you're planning for the future, stuff like that. All right. That was the end of that. Scenarios. Chris, did any other questions come up?
Yeah, Mike, thanks. We do have a few, so
Okay.
let me jump to the chat first. First one's, we are looking at buying my daughter a house or condo while she is at college. Can we look at it as a second home?
Yes. The answer is yes. And I've looked at it too. I've looked at it, but I've got 2 of them up at Reno. The difference is they wouldn't live together. So, yeah, you can look at it as a second home. Again, as long as you're not trying to make money on it, right? And you know, I would say that you wouldn't have a problem getting that one through.
All right, great. Thank you, Natalie, for sending this one in. Here you go, Mike. Over the last 17 years, I purchased 2 primary homes, had a HELOC, and refinanced twice. And she says to get a lower rate and decrease loan term.
Yeah.
With Greater Nevada.
Thank you.
They've been great every time. She says, I appreciate you being honest about the things to consider when purchasing a second property. So I guess not a question, but just a compliment to you guys.
Oh, yeah, that's awesome. Yeah, I just have, feel very fortunate. I've been here 6 years. I got a great team around me. Got, you know, a lot of loan officers that the thing about Greater Nevada and the mortgage consultants, right? Loan officers that work for us, they most have been with us for a really long time. I feel very fortunate. They're really smart. They know what they're doing. You know, they know the business, kind of all the guidelines. They're just a great group. And so you know, I do feel lucky to work with them. And so, you know, please, you know, if as you're talking, you know, if you're thinking through this, you can reach out to me. My information is here on the end. You know, I will 100% put you in touch with one of, you know, loan officers in our area, in wherever area you're in, whether it's Reno, here, Carson. You know, I support them all, even though my region is just, you know, everything but Reno. I still support all of them, and we'll get you with the right person. And so, Natalie, Natalie, thank you very much for your continued, you know, support of Greater Nevada on the mortgage side.
Yeah, we appreciate that. And Mike, here's kind of a good one, and just sort of a broad stroke, I guess it could be for your first home or even your second home, but simply, how do I find out what I qualify for?
That's awesome. Yeah, please. And that goes back to my last thing. I will, you know, if reach out to me directly, I'll put you with a loan officer. That loan officer, you don't have, I went through a lot of high level stuff in this, you know, PITI and, you know, interest rates and homeowner association, all the stuff that I was kind of bombarding you with. It's just things to think about. Okay. Just talk to a loan officer. That's their job. Their job is about kind of, you know, sitting down. They'll look at, you know, they'll run your credit. They'll look at your income. They'll tell you what, you know, what you can qualify for. And then you can make a, you know, good decisions on what, you know, gosh, yeah, could I afford another 1,500 or 2,000, whatever that vacation home looks like? Can I afford it? You know, and just kind of wrapping your head around that. And they'll tell you how much you qualify for, you know, and so that you can go out, and as you're shopping, you know, even if you don't have a realtor, they'll put you with a good realtor wherever you want to start looking, and you know, looking for vacation homes. And so you can, you know, go out with confidence, knowing exactly what you're going to get. And then, you know, just keep on talking to them about, you know, hey, I found one at this price. What would be the payment on it? I found one at this price. What would be the payment on it? Absolutely. Have a conversation with them. There's no obligation to any of that. If you decide not to go through with it, it's okay. Right. Even if it's just to find out what you qualify for, and you change your mind at that, there's, again, no obligation.
Perfect. Yeah. Thanks, Mike. And that looks like we've got through the emails and through the chat. So thanks everybody for submitting your questions today. And like Mike said, we've been sharing his information on the chat as well, so you can grab his info there and always reach out direct.
Definitely. Okay, a couple things as I close here. 8 minutes. Okay. Greater Nevada has aligned itself with EverFi here. And you know, EverFi is a company that just really talks about financial wellness, and you know, it's kind of the benefits you can see here on the slide here, exploring the benefits and costs of buying and owning a home or an investment property, whatever that is. And it's kind of financial awareness. And so you know, if you're interested in more, hey, Chris, where do they access this? Is this on our website or whatever?
It is, and Saray's always sharing those on the chat as well. So the links are right there in the chat, and then also on our website.
Wonderful, yeah. And so that, you know, EverFi is a company Greater Nevada has aligned itself with, to just kind of, again, trying to, you know, not trying to sell you on anything. It's just about financial, you know, awareness, if you will, and kind of working you through that. So there's some additional resources we have here. There's a mortgage calculator if you're really interested, and just kind of, you can go to, it's right on the Greater Nevada mortgage site. Okay. And keep in mind, you know, you have the credit union, but you actually, if you're interested in just doing some mortgage calculators there, and just, hey, what if I put this in, and what would be the payment on that, and this interest rate and stuff like that, there's a mortgage calculator on there. Balance is another partner of ours. You can see there, financial fitness, just kind of, you know, coaching people through that, questions people have. It's all, you know, all this stuff. Quite honestly, I feel like we do a real disservice for most people. And I'm not talking about Greater Nevada. I'm talking about our education system. People come out, My kids have come out of, school here in Carson City, and they have no idea how anything works, how credit works, any of it. And yet somehow we're supposed to just know that hey, I'm being an adult here. Let me just kind of know how. And, I've spent the last 20 years doing this. And so I feel like I have a pretty strong grasp on it. But most people just, they just need a little help with all that stuff. And so there's just some really good resources, and you can see Everfi there as well with that. So, and that's it. That's all I have. How much time? I gave you guys 5 minutes back in your day.
You did awesome, Mike. Thank
Yeah.
you. Thank you for the great presentation. And we even had some of our own employees, actually, you were spurring our minds with questions. So we were popping in some of those questions as well.
Good.
And thank you all for joining us from Renown. You've seen all the resources. We've got tons of things in the chat. And Greater Nevada Mortgage is also a proud partner of Renown. So should you think about closing your home loan with us, we have special perks for you all as part of the closing costs. And also you are all our heroes, and that entitles you to some additional benefits. So just reach out should you have any questions. And thanks again for joining.
Thanks, everybody.